With real estate as expensive as it is, especially in Vancouver and Toronto, it's becoming extremely difficult to invest in real estate as a beginner, nearly impossible to be straight with you guys. However, in this video, I'm going to give you guys a few ways how you can go about doing this. I'm 𝐎𝐕𝐃𝐄𝐒. I make Canadian real estate content and content about my local market of Abbotsford and the Fraser Valley. And if you guys want to chat about buying or selling here, where I operate out of, there's a link in my description that goes right into my calendar. Feel free to click it and book yourself into my calendar. So I owned 3 properties by age 25, 29 now for reference, and I managed to do that on a plumber's income. So I'm going to be showing you guys how I managed to do that. So my first recommendation, easier said than done, but this is the first recommendation. It is to buy a property that is cash flowing positively or very close to being neutral cash flow or very small amount of negative cash flow. Just get it as close to being cash flow positive as you possibly can. And basically what that means is when the monthly rent exceeds the amount of expenses you have to pay to own that property. Now, if you live in Vancouver or Toronto's metro area, I'm going to tell you that you're probably not going to find this. I mean, unless you Airbnb or you buy a 4-bedroom house and then add 6 bedrooms to it and then rent every bedroom out bedroom by bedroom, you could probably make it happen. But other than that, if you just buy and hold, a detached house or a condo, probably not going to happen. So assuming you're a broke loser, I'm just kidding. Assuming this is your first investment property, you should buy a property out of province like I did for my first investment property. Both of my investment properties were bought out of province, sight unseen, meaning I never went there to actually go see them. One was in Windsor, Ontario, and one was Edmonton. I've still to this day never even been in Ontario at any point in my life. Out of province, you're gonna find properties in, say Saskatoon, Windsor, Ontario, Sudbury, Ontario. I'm sure there's a bunch of markets in South Ontario that will cash flow. Kamloops, BC will cash flow. I'm sure there's places in Penticton and the Okanagan that will cash flow. Obviously, many places in Alberta that will cash flow. And even like Quebec has areas that cash flow. Winnipeg, whatever. There's a lot of areas outside of Toronto and Vancouver that will cash flow. Obviously, do your research. And if you're having trouble looking for a market to buy into, a place where I actually ended up finding Windsor, Ontario was the Bigger Pockets forums. And you just type in, best market to invest for 2024 in Canada or whatever. And there'll be a ton of people talking about a ton of different markets that you can invest in 2024. So my first property that I bought in Windsor, Ontario, cash flowed $400 a month and only required a $30,000 down payment as it was only a $150,000 property. So great first investment for anybody, like very low capital, upfront capital expenditure, and it cash flowed extremely low risk. I just sold that property a month ago for $290,000. So in 4 years, basically doubled my money and cash flowed the entire time. Now today that property probably won't cash flow, but it'll be very close to being cash flow. And then when interest rates come down and rent probably goes up, you're probably gonna be cash flow on that same property that I just sold. But understand that cash flow isn't the end all be all. People grow their wealth and become rich with the appreciation that you get by buying real estate. The cash flow is just a defensive metric. And because you likely don't have the assets or the higher income to support a cash flow negative property that usually are in supply, constrained, high growth markets, I recommend buying a property that cash flows or is very close to, just because of the risk that comes with buying those highly negative cash flow properties, and you don't have the ground to take on that, the base to take on that amount of risk. But understand that if I had a really high income and a lot of assets under my belt, I probably wouldn't be buying in the cash flow markets. I would be buying in the Vancouver metro areas and the Toronto metro areas. And obviously to buy in Vancouver and Toronto, not only are they cash flow negative, but you need $100,000 to buy a 1-bedroom condo. So they're not good markets for first-time investors, unless of course you have the capital or the income, or you could always buy with a partner. I'll talk about that in a bit. So how do you actually go about buying a property out of province? Well, you really only need 2 pieces to make the whole puzzle. You need a realtor and a property manager. And ideally, you're going to want a realtor that's been referred to you by another investor and a property manager that's been referred to you by another investor. And they shouldn't know each other in a perfect world, and they shouldn't work with each other in a perfect world. And the reason why is you can vet the realtor with the property manager's recommendations, and you can vet the property manager with the realtor's recommendations. So as an example of this, realtor sends me a property. Hey, this is a great area, should rent for this, excellent product, blah, blah, blah. I'm going to take that, email it over to the property manager. Hey, what are your thoughts? If the property manager says, this is a piece of crap property, never buy in this area, you're going to have high tenant turnover and a very bad tenant pool, so on and so forth, get rid of the realtor. Already, you know you probably can't trust this guy. And typically you and the property manager have a like interest, because you don't want to be buying bad properties in bad areas, and they don't want to be managing bad properties in bad areas, right? So it's really that simple. And then obviously when you put an offer in on the property, just put an inspection contingency in that offer. That way you know the state of the property before you remove subjects and buy it. You've pretty much got all your grounds covered, right? Property manager says, here's the rent to expect. Area's good. Realtor says area's good. We're going to, write the offer, and we're going to put an inspection contingency into it. The inspector comes in, confirms that the property does exist and it's in good standing. You're good to go. Second tip is to buy with a partner. It is almost always better to, give up a piece of the pie. What's that stupid saying? It's better to make 50% of a grape than 0% of a watermelon. I'm sure you can still find $200,000 properties in places like Moncton, New Brunswick, and other areas in the Atlantic, or even Quebec, where, you only need, $40,000 to buy a property, but if you buy it with a partner, you each only need 20 grand. Just make sure, if you're going to buy with a partner, first off, talk about the exit strategy, right? When do you guys plan to sell? When are you getting out of this, right? Because it will likely happen where one guy wants to exit and the other guy doesn't want to exit. And another thing you guys should definitely do is draw up some type of agreement by a lawyer. The last time I did it, I think it cost like $800 to just have them do up some type of agreement or contract or whatever it was, just to kind of outline who does what and all of the things. That way it's all on paper and it's not just hearsay. You can't just be like, oh, we never talked about this 5 years ago. Well, it's all on paper right here. And you can very easily ruin relationships by not having that drawn up. So 100% would recommend that you do that. But either way, partnerships are a safe way to get into the market, to just start learning about investing. There's going to be disagreements and stuff that suck about partnerships, but at the end of the day, your first investment property likely isn't going to make you rich, but it's going to get your feet wet. You're going to learn about the ins and outs and investing, and it's also going to make you more open to, accepting and working with the risk that comes with owning investment property. Because obviously the first time you invest in real estate, it's pretty scary. You're buying something worth a couple $100,000. But just like you go to the water park and you see the big scary slide, after you've gone down it, it's not scary anymore and it's fun, right? So that first property that you buy with the partner is you going down the slide. Even buy with 2 or 3 partners, right? Whatever. Have 4 people on title. Just get your feet wet into the market. And this really, really lowers your risk and makes it a lot safer, because again, if the tenant stops paying or repairs come up or a lot of stuff goes wrong, you at least have 2, 3, or 4 incomes to service the things that could possibly go wrong with that property. So that's basically it, guys. What I've personally found with investing, at least, as long as you are not doing something that could completely ruin your life if the worst case scenario happens, it is better to make a bad decision than to not make a decision at all, because you do learn the most from your mistakes, not your wins. So I appreciate you guys. Thanks for watching. Do not forget to subscribe. I'm 𝐻𝐿𝐇𝐄𝐒, and I'm making moves to move you. Peace.